The topic of my presentation is global harmonization of IFRS and accounting for digital currency. The continuous development of economic globalization has promoted economic and trade cooperation among countries. Accounting as a universal business language plays an important role in facilitating international trade and exchanges. My presentation will firstly analyze the adoption of IFRS by comparing the adoption of China and Australia. Then we will focus on the digital currency adoption, especially focusing on CBDS, and explore the challenges of applying IFRS to accounting for digital currencies. Finally, I will analyze the findings of previous part of institutional theory perspectives. International Financial Reporting Standards, also known as IFRS, are a set of accounting rules or a global accounting language for the financial statement of public companies that are intended to make them consistent, transparent, and easily comparable around the world. It is issued by the International Accounting Standards Board to develop a single set of high-quality, understandable, enforceable, and global accepted standards based upon clearly articulated principles. IFRS fostered transparent and trust in the global financial market and the companies that list their shares on them. Many of the world's capital markets and jurisdictions now require IFRS. However, the adoption of IFRS and plans for convergence or harmonization differ widely by jurisdiction. This is because country special contextual factors continue to influence the accounting practices, including national culture, political and regulatory system, and economic environment. So here is a comparison of IFRS adoption of China, mainland, and Australia. It should be noticed that as special administrative regions of China, both Hong Kong and Macau adopt their own financial reporting standards. So as relevant jurisdiction authority, the Organization of China is the accounting regulatory department of Ministry of Finance of People's Republic of China, which is responsible for the setting of accounting standards for business enterprises. So in Australia, the organization is Australian Accounting Standards Board, which develops and maintains financial reporting standards applicable to entities of Australian economy. On the IFRS adoption timeline, and in China, in fact, China did not adopt IFRS. However, China committed that Chinese accounting standards for business enterprises, which is known as ACC5AAI, was substantially converged with IFRS in 2005 joint statement, and now also committed to adopt IFRS standards for reporting by at least some domestic companies, while there is no timetable for completion of this process. And for Australia adopted IFRS in 2005. And next, for the extension of IFRS adoption, in China, the use of IFRS standards is not permitted for domestic companies or Chinese companies whose securities trade in a public market in China are required to use ASBES for financial reporting within mainland China. These standards are substantially converged with IFRS. However, Chinese companies whose securities trade on the stock exchange of Hong Kong may choose IFRS standards for purpose of financial reporting to Hong Kong investors. There are also a number of Chinese companies choose to use IFRS for the purpose of trading in the United States and in Europe. So in Australia has already adopted IFRS standards for all companies. The companies are for-profit entities. So this includes all companies whose securities are publicly traded plus others. So next, the extent of the enforcement of IFRS. So according to the accounting law in China, all the Chinese companies must comply with accounting standards issued by the Ministry of Finance in China. ASBES are a part of law and regulations in China. And in Australian IFRS standards including interpretations, are incorporated in Australian accounting standards and have the force of law, and all companies lodging financial statement. And then the extent of enforcement of IFRS. So China didn't apply the IFRS. So in Australia, there's no modifications with respect to for-profit entities, except that Australia has not adopted IAS 26 accounting and reporting by retirement benefit plans. In addition, there are also some modifications for not-for-profit entities. Moreover, additional guidance is provided in some standards for for-profit entities. So based on the comparison, here are some similarities and differences. So the comparative analysis between China and Australia highlights the flexibility of IFRS to adapt to local circumstances, at the same time maintaining a core framework that aligns with international standards. They all aim to establish a single set of high-quality global accounting standards. However, the method of adoption is different. China take IFRS as a starting point, but then take various changes based on the different political and economic environment, while Australia fully converges with IFRS and intends compliance. Overall, the global adoption of IFRS, despite its variations, plays a crucial role in enhancing the reliability and comparability of financial information all over the world. Another issue should be discussed is the global adoption of digital currencies. Digital currencies, mainly including cryptocurrencies and CBDS, are defined as virtual currencies that use encryption and blockchain techniques to ensure security financial transactions, such as Bitcoin. The adoption of digital currencies is rapidly evolving, driven by various factors including financial inclusion, innovation, and the need for efficient payment system. Cryptocurrencies is an early digital currencies. Due to its unique peer-to-peer transaction method, it allows one party to transact directly with another party without the need for intermediaries, which saves time and avoids the transaction costs charged by banks. In addition, digital currencies can be used for investment, which related to its dramatic price fluctuations. In recent years, more and more large companies are beginning to purchase, use, and promote digital currencies on social media platforms. However, the emergence of digital currency poses challenges to the traditional financial system. To address the impact of emerging digital currency on the traditional financial system, central banks around the world are developing CBDS to establish financial system and enhance financial inclusion. Central bank digital currencies, also known as CBDS, are a kind of digital currency issued by a central bank, aiming to enhance the competitiveness in the international financial system, improving payment efficiency, and reduce transaction costs. During the COVID-19 pandemic, social distance measures and public concern gave a further promotion to CBDS projects in many countries. As of late 2023, the exploration and adoption of CBDS have accelerated, with many central banks around the world either in the advanced stage of exploration or already piloting their digital currencies. Due to the novelty of CBDC, it is natural that the approaches will differ across countries in line with economic circumstances and users' priorities. According to the research of some factors can affect the adoption. So the first one is digital infrastructure. Areas with high mobile phone and internet usage have better infrastructure, which may facilitate the development of central bank digital currencies. Next, in countries with advanced digital payments, central banks may focus on ensuring competition, privacy, and availability of public payment options. The third one is institutional quality. Jurisdictions with higher government effectiveness are more likely to initiate CBDC projects, and at the same time, in areas with a large informal economy, central banks may aim to create a data trail for transactions by promoting digital currency use. For example, China is one of the first to adopt digital currency based on its highly advanced in terms of digital payment infrastructure. Services like Alipay and WeChat Pay dominate the payment landscape, reflecting high mobile phone and internet usage, which are crucial for CBDC adoption. In addition, the Chinese government's effectiveness in implementing policy and its centralized approach promote the technological innovation, including CBDCs. And the picture shows the different degree of the adoption of CBDC all over the world. We find CBDC projects to be more advanced where there is high GDP, high account ownership, and greater financial development. CBDC represents a significant shift in the digital transformation of monetary system globally. Here are also some challenges of applying IFRS to account for digital currencies. A lack of clear guidance in IFRS has resulted in diverse in practice in accounting for such currencies. The first one is unclear clarification in IFRS. Unlike traditional financial instrument, digital currencies don't fit neatly to existing categories such as cash, financial assets, or intangible assets. The classification affects how they are measured on balance sheets, whether at cost, fair value, or others. This presents challenges in accounting treatment, as different classifications can lead to varying accounting methods and reporting outcomes. The second one is lack of special guidance. Unclear clarification directly leads to unclear guidance with IFRS regarding the accounting treatment of digital currencies. This absence forces companies to interpret the existing standards as best as they can, which can lead to diversity in practice. The third one is regulatory uncertainty. The rapid evolution of information technology exceeds the development of accounting standards. Moreover, regulatory frameworks and regulations governing digital currencies are still evolving, making it difficult to determine how to comply with regulations while maintaining compliance with IFRS accounting treatment. It is difficult for IFRS to remain relevant and provide useful guidance on digital currencies. Addressing these challenges require carefully consideration. Considering all the information above, we can analyze the global adoption of IFRS and digital currency from institutional theory perspective. Institutional theory is concerned primarily with an organization's interaction with the political and economic institutional environment, the effects of institutional pressure on the organization, and the incorporation of these expectations into organizational practices and characteristics. In general, it explains why organizations within a particular field tend to take on similar characteristics and form. From the analysis above, we can draw the conclusion that despite there exist differences of adopting national accounting standards all over the world, the nature of these standards is converged with IFRS. In addition, central banks around the world are developing CBDCs to address the impact of emerging digital currencies. What else? These countries are all trying to take ways or make modifications of their standards to face the challenges of emerging accounting issues. Here, institutional theory is helpful to analyze such global harmonization of accounting standards practices or IFRS adoption, especially the field of digital currency. Drawing from institutional theory, prior research explains three institutional forces of institutional influences that drive the adoption of IFRS and apply or extend it to the context of the digital currency. They are cohesive institutional pressure, normative institutional pressure, and mimetic institutional pressure. The first cohesive forces. These are pressure exerted by powerful stakeholders such as government or market. So the first one, government and legal system. Both China and Australia have been influenced by coercive pressure through governmental and legal requirement to adopt and enforce IFRS standards. For instance, in Australia, IFRS standards are incorporated into law and must be followed by all reporting entities. In China, while the standards are covered with IFRS, they are adapted to fit within the specific legal and regulatory framework of the country. The second is the international market pressures. The global market exerted pressure on countries to adopt IFRS to attract international investors and facilitate cross-border financial companies. And third one is innovation technology. With the pressure of emerging digital currencies and digital disruption, governments are actively developing regulatory framework for digital currencies, particularly CBDS, which creates a cohesive force for adoption and compliance. So the second force is a normative force. This is from the group norm. So the first one is the professional accounting bodies. Both countries have professional accounting bodies and the Big Four accounting firm that develop and enforce the standards based on IFRS. These bodies also help in professionalizing the fields, ensuring that accountants are trained under similar standards, which promotes a normative approach towards global accounting practices. The second one is industry standards and practices. As digital currencies become more integrated into financial system, norms around their usage, security, and reporting are developing. In addition, the technology is already available or possible for the central bank to step in to protect the investor interest and share the return. So the third one of the force is a mimetic force. This is also called cultural cognitive force. The first one is successful precedent. As part of the global community, countries might mimic the adoption strategies of other perceived as successful or leading in financial reporting standards. Australians' full adoption of IFRS could be seen as setting a precedent that others in similar economic situation might follow. Then, peers and competitions. The rapid development of digital currency in some countries may lead others to follow due to competitive pressure or the perceived success of these initiatives. The adoption of digital currency by major economic and companies can lead to mimetic behavior among similar nations and firms looking to capitalize on first benefits. So overall, from an institutional theory perspective, the adoption of both IFRS and the digital currencies can be seen as driven by a complex interplay of cursive, normative, and mimetic forces. These forces not only shape how standards and technologies are adopted, but also how they are implemented and adapted to local contexts. As economic globalization continues to expand, the alignment with IFRS across different jurisdictions like China and Australia demonstrates a commitment to enhancing transparency and comparability in international financial reporting. Despite varying degrees of adoption, the underlying trend suggests a move toward global harmonization of IFRS and accounting for digital currency. At the same time, the adoption of digital currencies, particularly central bank digital currencies, is poised to change the traditional financial system. Driven by technological advancement and increasing digital infrastructure, countries are gradually embracing these innovations to improve payment efficiencies and financial inclusivity. In the future, the integration of IFRS and digital financial technologies will likely continue to evolve to accommodate new economic realities and ensure that financial reporting remains both relevant and reliable. Thank you.